Welcome, welcome. How we doing? Doing good, doing good. We'll see how the turnout for this class is. I don't think very many people will be interested in it, but I think it's something that needed to be talked about. Yeah, probably not very many. I bet there'll be 15 of us or something, but be 15 people that learn something useful. Yep, you never miss, we know that. Isn't he wild? Fucking, that's my brother right there, dude. Like, that's my best internet friend in history, dude. I went and crushed a cheeseburger with that guy in a parking lot and watched the eclipse. It was sick, dude. That's my brother right there. He's also completely fucking unhinged. Right, dude? That's sick, dude. Swoop me from the airport, crush a burger. Welcome, welcome, everybody. We'll give it a few minutes, but we were just saying, I don't imagine this will be the highest attendance class I've ever given. I wish it would be, but uh, some good info tonight. Likely won't even take a whole hour. We can make it take as long as you guys want. Of course, I won't leave early if you guys got questions or anything. Because long-term investing, wildly simple in certain ways and a little bit advanced in other ways. But big picture, long-term investing makes you money and is real, real easy. Things on a heater, huh? What in the world? I'm red on the VIX calls. A 20% into close yesterday is looking real nice right about now. Yeah, I guess. Pretty big pump on the core though, wasn't it? Wasn't it like 3 to 3.3? And that's 10% increase, you know? But yeah, this pump is nonstop. Yeah, and then the red book. That's a pretty big drop on the red book. I know yeah, exactly. It isn't beautiful for the consumer. And but that's a big drop on the red book. You know, the red book shows us, consumer spending. And 6.5 to 5.7 shows that, that spending actually did go down a little bit. I guess, oh, correction on core. 3.1 versus 3% estimate. But I wonder what it was last month. Oh yeah, market doesn't care. I mean, that is one thing, that consumer sentiment and stuff. You can get a trade off of it, but the stock market does not represent the economy, and the stock market does not represent the consumer. Yep, pretty much. And but the that double, we just I mean, we're still on the wait and see. I even saw, I think it was like Goldman Sachs or somebody came out and said that they actually, funny enough, the day before CPI came out and said that they have now decided, and still even today, no rate cuts this year. I'm still personally in that stance too. We'll see what happens. I mean, new Fed chair and we'll get a rate cut, but I think Powell stays in there, and thus far we just don't really have reason enough to cut. Okay, gonna make one more post real quick. Yeah, I don't think yeah, I personally don't see any reason to cut in September. I mean, that's just me, that's just me. I don't see any reason to cut in September. It is tricky that, we only got one more set of data coming in between here and there. At least I think I don't actually know if CPI is going to come out. We should get, God, but last time I swear the last meeting was non-farm payroll week. And so I don't know. We'll see. We ain't getting no 50 basis point cut though, like the Twitter folks are saying. I don't think, at least. Tag me when I'm wrong though. The lawsuit, man, I can't figure that out. That was no, don't tell anybody or anything, but that was all approved, through the federal government. That spending was. So I don't know what the real issue is. Kevin, how we doing? Straw Hat Day coming, Jackson Hole. Oh, dude, it is. When is Jackson Hole? I love that thing. Oh, dude, when I'm rich enough, dude. When I'm MMA rich, dude, we'll be sending out those stimmy checks to all the we'll be sending all the stimmy checks to the team members. What, Kevin? No, dude, you should DM me about that, dude. That's fucking heartbreak, dude. I cry when I see boat on the side of the road, dude. I'm sorry.
No, yeah, all my stuff got stolen out. I had it at the storage unit, and
No,
I went
fuck.
to check on the batteries because I need to replace one of the batteries. All my fishing poles and tackle. I mean, we're talking $8,000 or $10,000 worth of stuff stolen out of my boat.
Dude, I am so sorry, dude. I'd lose it, dude. I got a story for you about losing my fishing gear. I'll tell you at another time, but I've been there. I've been there. Okay, well, we're gonna get rolling, people. Welcome everybody. Happy to have you here, Dirty River. Tonight, slightly different lecture than I normally give. You guys know me. I love short-term trading. I love scalping. I love day trading. I love scalping. I like swing trading. But today we're talking long term. very, if you are a truly, if you're truly a long-term investor, long-term minded person, you treat the market very, very different than I discuss in most of my lectures, than most of us discuss in most of our lectures, as a whole, people who are trading derivatives, options, we focus on short-term volatility. That's what generally speaking makes options work the best and the quickest is when we can get those quick moves in a short amount of time. And so that's what most of us focus on in here. I know that, I've alerted some long-term stuff. Tilio has, of course, Nando has, Luigi has. I know, they're a little bit newer to doing it, not necessarily trading it, but to alerting it. But so I felt like it was time to, have an actual long-term investing lecture. I think that FaZe and I did one together, God, 4 years ago now, probably. It's lost, it's gone, it doesn't exist anymore. We all see, shout out MMA, dude's been just absolutely printing, and he always talks about long-term investing and things like that. I know that again, he is still big picture, he is still shorter term investing. He's just been able to capitalize on some extreme volatility in the market and have those share plays work really, really well for him. Obviously, Hood is one. It's worked great for him. We're going to talk about it today. It's worked great for him, but regardless, that guy hasn't even broken into the long-term gains bracket yet. You actually get a little bit of tax benefit if you hold things over a year. And so there's a lot of things that make long-term investing appealing to people. And so to start this off, and I do just want to say, I know we got a couple of people in here that do, buy some things long term and do study companies. And I want to encourage you to speak up. If I say something that you disagree with, or even you just want to add something, feel free to speak up. In the beginning, I'm basically just going to be yapping here for a little bit. We're going to talk about, some benefits, some risks, things like that. And then, of course, with me, I always take it to the charts. The the this is and we'll talk about this a little bit more. The days of being strictly a fundamental investor are, in my opinion, and I know some people will disagree with this, but they are behind us. I've been in the market on and off for, I don't even know, 15 years, something like that now, maybe even longer than that. And something that I've learned over time is things can be overvalued for an extended period of time. Things can be undervalued for an extended period of time. Some things that are wildly overvalued will never come back to fair value. One of the greatest examples out there right now is Tesla. That thing's got no business having the valuation or trading where it does. And it doesn't, well, I can't say it doesn't stop. It hasn't done anything in the last few years. Not to say it hasn't been tradable, but in a long-term investing mindset, it's been absolutely dead money for the last few years. And so, why should we want to invest? Why should we want to do those things? Uh, and it's not only is it for safety, but it's for longevity. As I said, we focus heavily in here on options. Options have a finite life. Eventually, the day comes that that option expires and it's either worth something or it's worth nothing. One of the great advantages to shares is that as long as you are investing in reputable companies, you are still, trading the charts and following the charts and, managing your risk reward and understanding what you're doing, it is virtually impossible for a share to go to zero. Is there some stocks that end up getting delisted and get clobbered and, never recover? Absolutely. Those are growth names. Those should be an extremely small part of your portfolio. One of the greatest examples ever of growth investing going wrong is Cathie Wood. She runs ARK Invest. We aren't going to get into how they decide to invest in things and where they get their information from, because me personally, I think it's not only intelligent questionable, but ethically questionable how they make their trade decisions. But she is the prime example of growth investing goes wrong. Cathie Wood was, the golden child of Wall Street. She made, from basically 2018 all the way running into 2021. She was investing in any little IPO small cap growth name she could get her hands on. And she had a lot of money to back it up, billions of dollars to be buying these growth names. She had billions of dollars in unrealized gains. And going into 2022, which anybody who understands a bit about investing, especially long-term investing, market fundamentals, overall, economic fundamentals, knows if you are going into a rate hike environment, you do not invest into the small cap market. Can you start to try to do a little bottom fishing? We're going to get into that as those names get absolutely demolished for sure, but you need to do your research. However, Cathie Wood somehow managed $20 billion and she missed the memo that you don't want to be full ported in growth names going into a rate hike environment. And so this is leading into something that I like to teach people. I like to tell them the worst, in my opinion, the worst advice you can ever get as an investor is it's not a loss until you sell. You'll hear people say that all the time. The Tesla bros that bought at 320 or whatever before the split, basically never saw profit until just recently, and then saw nice profit and then let it go back red. It's bad trading. It's bad investing. Share positions should have a stop loss. Is there exceptions to this rule? Absolutely. If you are truly long-term mindset, you're, SPYs, QQQs, VOOs, some of those, your major ETF names that we know they aren't going anywhere. They're going to be around forever. Those are the types of positions that really you only want to be adding to. My favorite one of my favorite growth names to talk about, just because Toasty was in here and, that's a good friend of mine. And, I love to make fun of him, is NNDM. Explosion, this thing did what? I mean, I don't know, 1,000, 1,500%, something like that. And a bunch of people rode this thing back to red, including Cathie Wood. Cathie Wood was big in NNDM. She was up 1,000% on shares. She ultimately took an 80% loss on shares. The worst advice you can get is to, oh, it's not a loss until you sell. You should always have a stop loss. I don't care long term, this is, again, SPYs, QQQs, kind of a little bit different. Apple, those kinds of names, obviously a little bit different. Anything outside of those major names, you need to have a stop loss. You need to protect profits. There's no reason to let gigantic gains, die. Another one, and this one is just the most hilarious story ever. Carvana. Everybody knows, MMA was short on this thing back here at 340. It dumped all the way down to $3.50. I saw recently people celebrating being break even on Carvana shares at 300. There is absolutely no reason to ever let something go this far against you. Long term, midterm, short term, doesn't matter. You should never, ever, ever let something go that far against you. And so that's something that I really wanted to push. When when you're younger, you can have a little bit more risk. You can have some of your long-term portfolio in some of those growth names. As you get a little bit older, you start shifting more money to the safer names. However, you always need to be protecting money. There's no reason to let $320 turn into $3 to turn back into $300 when the chart was telling you the story. And so that leads me into my next part. When we're long-term investing, you need to buy for a reason. I know that this is, this idea is kind of lost on people. I'm going to use Hood as the example because it was a conversation that MMA and I were having back in April. You need a reason to buy. And, you don't just see one day a red candle and buy the dip. Obviously short-term trading, we can think about those kinds of things. Really long-term investing on companies, you need a reason to buy. You need a reason to add to positions, and you need a reason to stop out of positions. And so this is for everybody. I want to point that out, that this is for the brand new investor that just wants to buy themselves one share of Apple, all the way to Dan, how we doing? Just say your message, Dan, how we doing? This goes all the way to Buffett, Munger, the greats. There is a very, very common misconception that that at Berkshire Hathaway, they don't use technical analysis. That is 100% wrong. In fact, one of the biggest parts of purchasing shares at Berkshire Hathaway is a simple moving average. And it's the 200 simple moving average. They use both the daily and the weekly. That is part of every Berkshire trade plan. That's where they try to buy. You can go look at Oxy, look where their buys are. One that I love to talk about, because for anybody who doesn't know, Berkshire, they're oil. They like oil. They like energy. They like, they aren't tech people. They hold Apple. That very well could be, maybe one of two tech names that they hold. And obviously they've trimmed it. Well, just recently, well, I mean, back somewhere around here, uh, everybody was talking about, oh, Berkshire sold their SPY, Berkshire sold their QQQ. And people were making a very large deal out of this. And I was trying to explain to everybody, who cares? Did ultimately they have a very nice sell before this sell-off? Yes. However, SPY is $40 higher than where they sold. Why would somebody like Berkshire and them be in SPY and QQQ? The answer is very, very simple. If we pull up our weekly chart, and I'll get rid of these other ones, so we just only look at the 200. It can be This can be the simplest investing strategy ever that can wind up disgustingly profitable for you. So I'm actually going to add a little bit of time here. So this is the 200 weekly moving average. So it is giving us the average of the closed candles over the last 200 weeks. So basically, you're looking back 4 years, give or take 4 years, just shy of it. Well, you can also see on a major name, we spend very, very little time below the 200 weekly moving average. That is why for many people, Berkshire Hathaway included, it is the bread and butter of long-term investing. And so we can see back here, 2007 to 9, the financial crisis shut down the whole world. We did. We spent a few years under the 200 weekly. Generally speaking, moves under the 200 weekly looks something like this, like we got in COVID. If you get some closes below it, you see extreme volatility under it, and then oftentimes you're going to get bought back up. Well, why was Berkshire Hathaway in SPY? Why was Berkshire Hathaway in QQQ? They don't invest in things like that. The answer is very, very cut and dry, and it is quite literally, at least in my opinion, I don't sit on their board. I don't know what they're doing. Here you go. SPY was at the 200 weekly moving average. They bought SPY. It's that simple. It's that cut and dry. Why did they decide to sell at 600? I don't know. I have no idea what prompted them to sell. Likely because they're extremely intelligent and they knew that a lot of the policy that was coming out could have a pretty negative impact on the market. So it's worth it to reduce your exposure on those major names. It is also worth pointing out that they were in, the largest ETF on the planet, and they caught a 70% move in 2 years. Absolutely gigantic move off of that 200 weekly. Long-term investing can really be that easy. Are you going to get a lot of chances at the 200 weekly? Absolutely not. You'll get a lot more chances at the 200 daily. Reclaims the 200 dailies, oftentimes an unbelievable buy. Break and retests of 200 dailies, oftentimes an unbelievable short. So one that I want to use for people, because I know a lot of people trade it. Let me see, I'm going to create a new drawing set, is Hood. And it's no secret, I've been bullish on Hood for a long time. I think you should be bullish. They just have so many users. They're making money. They're in the crypto space. They're in the stock space. They're in the IPO space. They got, they're given excellent, returns for uninvested cash, many, many reasons to be bullish on Hood. We all know MMA had that great entry. I don't remember where it was, somewhere back here, super low, caught the nice run up. Well, beginning of this year comes along and him and I start talking. I wonder if I even had the circles just so, oh, look. Okay. So this is mean. I love MMA. He's a good friend of mine. Hopefully he would laugh that this would be going on. So these were where he was purchasing Hood on the way down. Um, I could find us when we were trading at I believe it was this day right here. He bought Hood at 39, and I told him my words were wait for 32, 33. All I was looking for was this 200 day. He had been buying and buying and buying on bad news. And did we come to a place where, hey, you could take a little nibble and try? Yes. But that's what you need to do as a long-term investor. You need to have patience. You don't buy up here, you start seeing the pullback. Maybe you try at the gap fill, but you have to start to ask yourself, how much risk am I willing to have on this trade? What's going on in the world? Should I slow down on the buying? And this was a surefire sign, very bearish price action. Everything about it is very bearish. Strong downtrend, all bounces getting sold. No reason to rush in. So did we ultimately end up getting that 200-day test? Yes. Took a nice bounce before it, obviously. I think actually, if we looked at the 4-hour chart, I believe we got within $1 of it on this day in the after hours. But wait, let the trades come to you. If it is not, a 30-year hold, you need a stop loss. You need to be aware of the risk. Maybe you buy the 200-day, and then if we get a weekly close below the 200-day, that might be your stop and you look for lower to entry. You need a reason to buy. You don't just buy because we had red days or one red day. You don't just buy. I mean, we've heard it on Tesla this whole way down. Oh, 400, you got to buy. 380, you got to buy. 350, you got to buy. 300, you got to buy. 220, you got to buy. Ultimately, they ended up being right at 220. But the stock moved $200 against them trying to buy every dip. You need reasons to buy. The other thing that I really like to push people on is you do not need to be the first person in the trade. You can see this dip hits and we hold it for a couple of days. Maybe we get this nice big push up and you can start to say to yourself, okay, technically speaking, I know not everybody trades these. They work great on short time frames. They work great on long time frames. We got a nice little 3-push wedge situation going on here. We've pushed back up. We've now set a higher low. Is your average 35 or whatever this would have been when you bought it? No, but you let the buyers show up. You get the nice entry in that 39 to 40. Is it the lows? No, but you let the market tell you to buy. You don't just want to be in there, diving in, averaging down shares every single day. Sometimes it might take weeks or a year to finally get to your buy price. No big deal. Market will always be here. My favorite buy that I've ever been a part of, and this one's going to crack people up. We probably even need more than this. So AT&T, you guys all know I traded a lot. You guys all know I all traded a lot. So, and put in, oops, I forgot. So put in a very nice move. So some of you might remember we were buying AT&T right about 14 bucks. Well, why? And I was not recommending buying T for this whole slide down. They were having fundamental issues. We're going to touch on that next. They're having some fundamental issues and things like that. We were holding well below that 200 weekly. There wasn't a lot of reasons to be a buyer. Why did I finally decide to give the alert, at this 14 bucks? Because I looked left on the chart and I said, where is our spot to buy? And you can even go back and find it. Where me and Toasty are talking about, we're looking for that 2022 double bottom. So that's ultimately what we got. As crazy as it is, or sorry, 2002. I'm looking now, it's actually a 2003 double bottom that we were buyers of in 2022. We had seen the bounce off of it. We had seen the pull back down. At that point, it's technically a third, triple bottom. We bought here. We weren't buying AT&T. Everybody wanted to be buying AT&T. Nobody wanted to be buying AT&T but me, if I'm being real here. But I was not looking to buy AT&T until we set these lows down here. And so you can see, like I said, like that is a not joking 20-year apart double triple bottom that we played. You let the trade come to you. And then ultimately you can see now we pushed up about 100%. It's not no glorified hood 500% ripper, but nice 100% ripper trade backed by technicals, backed by fundamentals that we sat there and we waited for. Well, this is great. Sitting and waiting is great. It's not always going to work. So sometimes you have to look to get an entry. Sometimes you have to look to take that early entry. But that doesn't mean a full position. It doesn't mean anything like that. And I don't want to say you need to, but I like to recommend you trade against or with that position. So we're going to use what would be a point where I cut T-shares? Well, if you're in there at 14, you're up 100%. I'd probably run my stops, I don't know, somewhere. I mean, you want technical breakdown, I mean, let this 200 weekly start catching up. You want a true technical breakdown, not just, your little 5-minute chart technical breakdown. You need to see a fundamental and a technical shift to then take your money and look to re-enter at a later time. Or, and this, I liked your question because it kind of goes into what I'm talking about, or manage the position. So what do I mean by doing that? I basically mean hedging. It's not always a hedge, so we can't just classify it as a hedge, but we can still trade these equities. So say you hold AT&T shares and you know that, we are pushing into some sort of resistance. You now have two options. You're still a long-term holder of T, you're collecting your dividends, you got no issues. But we're coming to a point where you might get a pullback. Trade puts. Are you actually making money? Say you have 100 shares of AT&T, okay? And we're pushing up, we're pushing up into this 29, which it's been getting clobbered down off of a million times. Stock hasn't done much for a little bit. It's been basically sideways for the last, year, this whole 20 or, last 2025 so far. Hasn't really done much. So we can trade puts. And we aren't necessarily trying to make money, but we can say, okay, 29 has rejected. I hold my shares. I'm tired of it doing nothing. And so I want to trade puts against it. And so I enter the puts and maybe I make, maybe I make $50 or whatever. Well, if we got our 50-cent pullback, down to, say we short 28.50 and we get down to 28, well, now our shares have lost no money. Your broker is of course not going to identify this for you, but your 100 shares lost $50 in value. Your puts made you $50 in value. You're still sitting even. So when you have shares that you're holding for long term, years, it doesn't have to be for the rest of your life, but you have a long-term view on it. You've been holding these shares for 2 years, you trade against them. You take those opportunities every once in a while. So, say you bought your 100 shares at $14, you're in at $1,400 total, you're obviously up 100%. Well, you've scalped and you've day traded and you've traded against the position this whole time. You have likely made $1,400 on options trading with or against your position that is now financed your $1,400 share position. Again, it will not be reflected in your brokerage account, but you will know I've scalped $1,500 over the last 2 years. My shares cost me $1,500. I have no risk in this trade. That is the most powerful thing you can do in long-term investing. I'm not saying that you should do this or anything, but your shares are free. Your stops can be at zero and you can't lose money. That is what everybody's goal of trading should be. Your scalps, you guys all, I'm assuming a lot of you scalp with me. We're making 10, 15, 20%, whatever it is. It's not huge money. It's financing other trades. Maybe I'm in some Apple calls and I'm down 10% on them, but I've been able to scalp 20 bucks on SPY a few times. My Apple cards are now free, so they get to work. Well, maybe that day trade works. So now I want to roll some profit into a longer term swing. Well, if that swing works out, I now sell that and buy shares. And now you start the whole process over. You scalp and you scalp and you scalp and you add to your position. Scalp and day trade and swing and add to your position. That is what everybody's train of thought should be when they are looking to long-term invest. Again, like I said, this is relatively, I don't want to say, trading is easy, although I do say that all the time. I don't want to say this is all easy and it's all super cut and dry and just buy the 200 weekly and you're going to be rich tomorrow. That's not what long-term investing is about. We want to sit and we want to patiently wait for the best possible entry. Uh, you know, we want to wait for the best possible entry. And when it comes, we take our entry and now we ignore those shares for the most part and we trade the market against them. I had all kinds of friends. We'll just go back to SPY. I had all kinds of friends during this. Do I just cut my SPY? Do I just sell my SPY? We're getting smoked. We're getting absolutely, like, I'm getting wrecked, blah, blah, blah. These things have flushed $140 on me. And all I told every single person that asked me, you should probably be buying. You buy. You don't sell these kinds of things. Something like a SPY, you trade against it. Was it worrisome? Was this the most aggressive selling I've ever laid eyes on, as well as basically everybody else? Yes. And self-inflicted gunshot wound, all of that. But these are buying opportunities. That's what a real dip buyer looks for, is nice pullbacks to places that give you a reason to buy. Once you have that reason to buy, maybe your technicals are lining up, your fundamentals are lining up, every single thing is lining up. You buy, and now you trade against that position. If it's a trade you believe in, you continue to add. And so that's the next thing I want to talk about. Does anybody have any questions? Again, I'm just yapping over here, pointing at some things on charts. If anybody's got questions, feel free to ask them. So that's the next thing I want to talk about is sometimes things don't come back. We are never going to be able to buy SPY at 60. That's just, I can't say never, but we're never going to be able to buy SPY at 60. So how do we manage buying more on things? This is things you believe in. This is your Apples, your Amazons, all of that kind of stuff, your major ETFs, your SPYs, your QQQs, even your IWMs. Small caps always have their day. They deserve a small part in your portfolio. Well, you can't, I don't want to say you can't, but you can't always just wait for 200. Yeah, absolutely. Yeah. Feel free to interrupt. Let me finish this, but then feel free to interrupt. So you can't always just wait for the 200 weekly, because you might be waiting forever and you might miss out some good buying opportunities. So I have a friend of mine, and he is not a trader. He is exclusively an investor, and he is exclusively invests in SPY and QQQ. I am not telling you this is the right thing. I'm telling you his strategy. This is a strategy for adding to your winners, adding to your positions. So he knows SPY. It's the 500 biggest companies around. It's always going to trade good. It's always, it is going to keep going up. Like, Al Brooks mentions it. SPY has been in an uptrend, technically speaking, since, or not SPY, but the S&P has been in an uptrend since the 1920s. It will continue to be in an uptrend with some nice volatility downside here and there, but his strategy is appallingly simple. He always buys at a 200 day, and he always buys at a 200 weekly if they show up. As we know, they show up rarely. So he has enough money and he wants to keep adding to his Roth and adding to his 401ks, and he's all self-managed. If the S&P pulls back 5%, he adds shares every single time. Like, no ifs, ands, or buts. So if we go to something like this, we got SPY, um, it pulled back 5%. I could call him right now and say, did you buy SPY at 582? He'd tell you yes. Next one, we come down here, SPY's down another 5%. I could say, did you buy SPY at 552? He'd say yes. We get another, whatever this is, 5% down. We could ask him, did you buy SPY at 523 or 522? He would say yes. That's his method. If a 5% pullback comes, he buys a couple of shares. Obviously, his bigger purchases are going to be at things, like the 200 weekly, but he uses that, nice little statistical pullback. It's easy for him, it's cut and dry, and it's in something that he knows is going to continue to go up. Would he do something like that on Hood? Absolutely not. That's not how you trade these things. Growth stocks, entirely too much risk. Would he do something like that on Apple? Probably. He's not an Apple investor, but probably you buy those pullbacks. And then, of course, if you come to big technical places, you can take it. But you buy the pullbacks. You develop your strategy for however it is you like to, trade them, and you trade it. I will say the other strategies that he uses is all sell to open stuff. He will, he'll do covered calls. He'll do, but let's be real here. Most people don't have the shares to do covered calls on SPY and things like that. So that is where some of his money that he invests back into SPY comes from. But simple. Keep your long-term investing simple. Keep bulks of your money in safe places. Put some money in high-risk things. Put some money in your, PLTRs, your hoods, all of that to try to catch those growth runners. But stick with those. Then, as far as a stop loss, I don't want to say you have no stop loss on things like SPY and QQQ. I mean, most people in 2008, 2009 were sure wishing they had one. There's times and places where it's best to just stop out and buy again. But you want to use stop losses based on the financed level of your position. If you've been trimming and you've been making money all the way up and all your shares are paid for, that stop loss can be very, very wide. It's as much profit as you are willing to give back. You shouldn't be trying to buy shares for 1 or 2% gains. If you're a day trader and you trade large positions, and you're thinking in relation to your large portfolio size and you trade shares, 1% on shares can be great for day trade scalps, things like that. Long term, you don't do that. You're looking for big goals. You're looking for those, extended fibs or, big pushes up is what long-term investing is about. And you leave a long-term investment because I've seen a couple of people ask about this. You leave a truly long-term investment, not a long-term trade, like maybe you've been holding Hood for a few years. I don't know when Hood IPO'd, but maybe you've been holding Hood for a few years and you're happy with it. And you're saying to yourself, how much growth can they really have? I'm actually going to take off this position. I might look for a re-entry down the line, but you're happy with it. A truly long-term position, your Apples, your Amazons, your Microsofts, those types of, your Mag 7 names, you need extreme fundamental and technical breakdown to exit those trades. A prime one, Meta. There was so at this time, 2022, there was a million reasons to exit the Meta trade. They were doing a change of face. They were doing a change of logo. They were doing a change of name. They were doing a change of business model. Every single thing was changing. And, ultimately it's worked out for them phenomenally. This was a trade to stop out of. The fundamentals and the technicals were breaking down on. So this was, and I'm just pulling a random one out of my head because I thought of it. This is the type of trade you stop out of because everything has gone against you. Not to say you never trade it again, you never long it again, but you wait for a reason to long it, which ultimately ended up being Jim Cramer crying on TV and apologizing and saying he was wrong about Meta. That was the buy, Okay, Manny, what do you got? Sorry, that went on a little longer.
No, you're all good. You're all good. I was taking my time listening. I had a couple of questions in regards to the long-term investing, and one of the main ones was like, when do you know when to exit to collect your profit, or do you just move your stop loss up to the take profit?
You just move your stop loss up. And something that I tell people, you move your stop loss up, but not super tight. You really need to ask, shares, and again, barring your truly long-term retirement, your 401k Roth ETF investments, you take profit when you're happy. You should still be trimming some shares. You should still be finding yourself in finance shares no matter what. And then as far as your stop loss, you bump it to a technical point where if a breakdown comes, you expect more downside, potentially, we'll say, and I'm just, potentially to a place where you feel it would be worth investing in again. We're going to stick with Meta. Tariff stuff, obviously very, very bad for the market. When the bad tariffs were in effect, I don't think anybody thinks 10% tariffs are bad. That's what I've said forever. When the not smart tariffs were in effect, or at least being talked about, nothing good going on. So this to me, very technical breakdown. If you're up nice on Meta, you likely want to book at least a good chunk of your position and look for a re-entry. Ultimately Meta sold, I don't know what that is off the top of my head, 30%, 35%. Well, it 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 in the end came down to a point where if you look left on your chart, as you should always be looking left on your chart, big consolidation for an extended period of time sets you a nice double bottom. This is where you look to re-enter. You ratchet your stop up once you're happy with the profits, but it doesn't need to be tight. You just need to say, God, I am happy at 675 and we're at 725. My stop's at 675. That's, I'm willing to give back $50 a share. Or you trade against the position, as we discussed earlier, or you trade against the position. But as far as taking profits, you for full exits of the trade, regardless, you need fundamental and technical breakdown, in my opinion. That's how I treat them. I do think all trades, even long-term trades, deserve a stop. Which I'm realizing we're running a little bit long. But I am going to yep, exactly. Viral. And it's real. When you're happy with the profits is when that stop needs to be moved into profits. That's it. But that's going to lead me into the next thing that we're going to talk about, because I see people trading them. Leaps. A lot of people talking about leaps lately. They're getting pushed super heavily. I'm not exactly sure why nobody talked about leaps until we were at all-time highs in the market again. We're going to kind of ignore that side of it and understand that leaps on most things, when most things are at all-time high, are not a very good strategy. We are going to Oh, well, all we've been talking is shares, Crashmas. All of this, everything we have said so far is shares. Everything that I've just discussed is shares. You trade options. Okay. You trade options against your shares. But now we use our leaps to buy shares. Leaps are the most powerful tool in the option trader's arsenal for somebody who has a truly long-term mindset. As I said, are you buying Meta Leaps today? I hope not. Is Meta probably going to keep going? Yes, but it's not the time to buy. You want to buy deep pullbacks. You want to buy those kinds of things. Well, why would we opt for leaps over shares? And the easiest possible answer is the amount of leverage we get for little to no money. When we, for anybody who wasn't here, we just did our options Greeks lecture. Leaps are the most wonderful way to be provided not only a large amount of leverage for a small amount of risk, but leverage that over time gradually increases at no cost to you. So we're going to use, even though it's trading at all-time highs, or well, not all-time highs, but it's got 15-year highs. We're going to use T. Do I think you should buy T like leaps right here? Absolutely not. You don't buy leaps right now. Hey, Manny, I'm in there with you. You gotta be. You gotta be. Leaps. Why do we trade them? What's the point? What's the reason? It's leverage. So you can see right here, delta. That's this column right here. This is what is very, very crucial to you in a leap. So the delta is, to put it in simplest terms, we aren't talking Greeks tonight. It represents how many shares this option contract represents, because we know that delta tells us how much money will we make or lose if the stock goes up $1. So we know if the stock goes up $1, we make $47. If we have 47 shares and the stock goes up $1, we have 47 shares. So that is a great way to simplify delta in your head. So when we're looking at a leap on AT&T, again, I'm just using AT&T as the example. They're obviously cheaper than a lot of leaps are, but maybe you're like me and you do think that AT&T is going to go touch that 30 mark, sometime over the next year, whatever it is. And I have to point out, these are even 2027 leaps. Well, you could go out and you could buy yourself 47 shares of AT&T. It's trading what, 28.50 right now. So you could go out there and you could buy yourself those shares of AT&T. It's going to cost you, I'm doing the quick math in my head, so feel free to correct me if I'm wrong, $1,250, $1,300, maybe a little bit more than that. So it's going to cost you $1,300 for 47 shares, or it's going to cost you $240 for a leap. So that is where the power in leaps is. You spend $240 to get the exposure of 47 shares, and you're paying 80% less than if you bought those shares. That is where the true benefit in leaps comes from. Now people are going to say, well, why doesn't everybody do this? One, they can still be expensive. I'm not saying you should. In fact, you likely shouldn't. You want some Tesla leaps that are, some 350 calls. They're going to cost you 10 grand. Is that a lot of money? Absolutely. But you're getting 65 delta. So if you have 65 delta, you can go buy this $10,000 leap if you're bullish on Tesla. Rest in peace if you're bullish on Tesla, though. Or you can go buy 65 shares of Tesla at $340 that will cost you $22,100. So it's 10 grand less. Why is this beneficial and why doesn't everybody do this? The issue is, yeah, exactly. Crash, let's go get your brain looked at too. The issue with this is as we discussed earlier with options, they have a finite life. In January 2027, if Tesla's trading at $350, this thing is worth $0 and you lost $10,000 to it. So the safety in shares is lost in leaps because the leap can in fact go to zero. Can the shares go to zero? Yes, like theoretically, but not really. So that is why you trade leaps. Oh, I don't know. Yeah, I mean, I'm not going to say you're wrong. I mean, Tesla fanboys will be Tesla fanboys and they'll keep on buying, I'm not going to say it's right or wrong or anything like that, but, we aren't talking about my hatred of Tesla currently. But this is where the power comes from. They, of course, carry risk, but, it's manageable. So we're going to go back to T just to talk about this. So here's the deal with leaps. As I mentioned yep, exactly. Josh, you also get tax benefit because long-term capital gains. And so we're going to talk about leaps here. I don't care if you have a year at a time. When your trade plan is done for, you stop out. That's all there is to it. Like we could say, maybe we buy those AT&T 30 calls right here at the top for, maybe we're like, I don't know, we drank too much the night before, so we just want to buy calls at massive resistance. So we do it, so we buy our leaps. Well, breakdown of this 200 day is a very, very big fund or technical breakdown. It's likely going to have some fundamental backing of it as well. So that's our stop. I don't care if you have 2 years, exit the trade. You're in, we're buying our 30 leaps on T, and all of a sudden we're trading 25. You are a million times better exiting that trade and maybe getting some 27 leaps or some 26 leaps. Of course, waiting for the market to tell you to buy, but stop losses become much more important on a leap, in my opinion. I can't tell you the amount of times people have, DM'd me or asked for help or whatever and said, oh, I got time, so I'm gonna swing. And then it never turns around on. I mean, God, I can't even lie. I'm in one right now. And I'm clobbered. So I bought what I thought was going to be the bounce on this thing. Then I said to myself, okay, I'm going to stop under this when we get a strong close under this 1261. Well, the strong close on the 1261 was like a 3 or 4% down day against me. So I'm stuck in there. Yeah, my contracts, they had, whatever it was, 3 weeks time. Well, they expire Friday. They're down 90%. Time, and I know this isn't exactly a leap, but time is not a reason to hold a trade that you were wrong on. That's all there is to it. So when you're on a leap, you need to exit and reposition, at least for me. That's my opinion on them. But they are helpful for added leverage with additional risk because it can go to zero. Now you start trading leaps, and there is one additional thing you can do. You can do what's known as exercising the contract. Maybe you really, maybe T, we're in our 30 calls on T. This isn't going to happen. 2027 rolls around and we're $20 in the money. So we're stoked on these T calls that we bought for $200 and they're trading at $2,000. Well, maybe we're still overall really bullish on T. You can exercise that contract and you'll lose your premium. You'll lose the $200 you put in there, but you will be given 100 shares of T for, $3,000. And they're trading at $5,000. So you're already up $2,000. So there's times and places where you end up deep enough in the money that exercising those contracts will actually make you a little bit of money and you're able to remain in that position. Or you can always exit if you remain bullish on it, get back into leaps, look for a dip, get back into leaps. But don't buy leaps at highs, buy leaps at lows. One I'm kicking myself for. Me and Crashmas were trading this one. I should have just got in these things with time and really held on to them. You can see the 3 entries that I took, but I should have just got into these things with time and held on to them because it's a company I believe in, project I believe in, fundamentals that are gradually heading the right way. Still, cash is always king, but a lot of potential for this company. I should have bought a leap, but I didn't. I should have bought the 10 leaps. I'd be, $3 in the money and happen. But I didn't. But these are, I'm not saying just clobbered things are what you want to buy leaps on, but things that have given you a nice substantial dip that you are bullish on. You see the long-term potential. I mean, one that, again, I'll just use Crashmas again. ASTS. He's been preaching this one on Trade For. Everybody has not been listening, myself included. I mean, he was probably telling us to buy this thing back at 20, I mean, I'm sure he was, and it's running. Beautiful setup for leaps. You get a nice push up, you get a substantial pullback, give or take 50% pullback, to a 200 day. You're noticing what is also a beautiful entry for shares is oftentimes a beautiful entry for leaps. So run with it. Long-term investing is much, much easier. Greeks are extremely accurate. That's one of the great things about it. It's hard to tell you what the Greeks are going to do on a same day, but the Greeks are going to be extremely accurate on a leap. And so with that, that's all I got. I know we only got 5 minutes left, 6 minutes left. Any questions, comments, concerns? Did I contradict myself and you didn't like it? What do you got?
Hey, real quick, if you don't mind.
Yeah, give me 1 second just to respond to viral. Yes. Look, I mean, we're under the 200 day, slightly worrisome. This is where you try. My opinion is if you do see that technical breakdown, you exit it. You definitely exit that if this breakdown comes, but beautiful spot to give it a test run right there. Yep, thank you, Dan. Everybody. Zeph, thank you. Yep, Janglish. Okay, Nick, what you got?
Yeah, so because talking about that 200, and we're talking about when we're going down to it from the top. On the flip side, if we're under the 200, like, and going up to it, because that's where you're supposed to be shorting, right? It's when you're under the 200 and gonna test it, or
So
would
yes and no. I mean, we just so happen to have IBM right here where it gave us the beautiful breakdown below it. The issue, so the issue with it, at least on a 200 weekly, it's oftentimes the rubber band point. A breakdown of a 200 weekly or a 200 day, and then a break back above is oftentimes going to get you on a ripper. So you do want to be cautious. I can actually this is a funny one. This is 2022 back here. And you guys are going to crack up at this. We closed, you know, thankfully we didn't short 348. Somebody in OT did. They alerted it, unfortunately. Some in the money puts that got smoked. So thankfully I didn't short 348. However, Tilio and I swung short right here. It was the break of the 200 weekly. We were getting, technically speaking, our second close under the 200 weekly. The risk reward favored some volatility to the downside. It also gives us an extremely cut and dry stop. So as I recall, we shorted this thing the following Monday. We gapped up, a few bucks, whatever it was. Looks like $8. Gapped up, got a little pullback. We stopped out for a loss. So, there's times and places it can work really well. It's funny because I actually just saw somebody mention one. So ENPH, obviously, broke this 200 weekly. Fundamentals were getting destroyed. There was no reason to remain long here. Beautiful place to take that short on it. So there is times and places, but just know 200 days and 200 weeklies oftentimes provide large volatility. So you need to be ready to admit you're wrong. If the market's broken it, but it decides it's not ready to be under there and it wants to run, you need to be ready to admit you're wrong. Of course, it's
Yeah.
tough because you might get the push right back over and then crater under it. But just be cautious having too much bias in either direction. Obviously, this type of thing, you can still be looking to short any of these bounces up towards it. You start seeing the 200 weekly curling down, you can still pretty comfortably be short on it, but be relatively cautious being too biased one way or another, at least on options at the 200 days or weeklies, just because, we can actually use SPY's 200 day. This one got a lot of people, we broke below it. It did provide a nice little short, pushed back up. You wanted to short it, but you also knew it was the first break of the 200 day, so you didn't really believe that it was going to stick. But maybe you short it, to try it. This next candle, you kind of doji out above it. I would likely be taking my stop on shorts right there myself, because I would not think it was going to go back down. I would think we were about to consolidate at the 200 day, and you'd ultimately be wrong, Or maybe you were the person who bought the break back over the 200 day, thinking we're gotta pop back to 580 or whatever it was, and you got smoked the next day. So shares, relatively safe buys. You might get a dip below, it might bounce back over, whatever it is. Options, you want to be cautious there because we know it oftentimes provides very big volatility.
So yeah, because I kind of got on Delta Airlines, we were like right at the 200 daily, and so I was looking to short it, and then you kind of see how today went. So
Yeah. So I will
Yeah.
tell you right now, you send me this trade, this day, this candle, I am 100% short right here with you. No questions asked, because I view this as a perfect spot to have the tight stop on a short that ultimately is dead wrong and gets blown out in like epic fashion, in 10% up day against you fashion. So I see what you're doing here. There's reason enough to be short here. That 200 day would have been confirmation for me. I also would have been looking at it as range breakdown with the retest, still lower highs, trend retesting this. I see that trade. this is one of those ones where as we, you slap some news on a break back above a 200 day, you're going to explode. Same as you slap some news on a break below the 200 day, bad news, and you're going to drop. But you're looking at the right thing there. Just one of those examples where it didn't work for us, But I can say
Now,
I would have taken this trade. I mean, where was that trend? Yeah, I mean, I would have taken this trade and then, eh, that's a nice little drop. You got a buck drop, but I would have shorted around that trend. You likely would have trimmed here. I would have felt super comfortable swinging short. Like,
yeah,
I mean, you get the big push up, then I'd go to my daily chart and I'd look at this and say, well, yeah, the bulls got obliterated today, closing below the closes of, both of these other candles, unable to hold gains. Why would I be long here? And then you get a 10% update. So, that's just the way it's going to go sometimes. But I like where your head was at. I like what you're seeing for sure.
yeah. And I have shares, so I mean, it's not like I'm super upset. But
Right.
on the flip side, when we get above that 200, would you be looking long here? Like, would this be a point where you're like, okay, now I'm expecting more up movement?
Well, so this one's funny. Great eye on this trade, too. I just got to point out. This one's funny because, to be entirely honest with you, it does provide the long trade. Because, I mean, it would have been tough. Did it do it right off? I mean, okay, so I have to rephrase. Did it provide the long trade? Yes. Did it provide you time to enter that trade? I mean, that's the 1 minute. No, not in my opinion. You want your entry around this 54.75, break back into it, stops below this trend if it shows up, breaks back into it. You don't want the entry $1 higher than your planned entry. But I will say, if we ignore the fact that the entry wasn't necessarily given, it gave the short trade that paid a couple bucks. It also gave the long trade that probably paid like the biggest a Delta contract has ever paid, I mean, so yeah, your eyes in the right place. If you were lucky enough to be on this thing at open and hammer it on the break above that, knowing where your stop is, nice trade, but would have been a tough one to actually make happen. Oh yeah,
Awesome. Thank you, man.
yeah, no problem. GTLB, is that what it is? GTLB. This is the Kathy Woodstock though, so I'll tell you what, it instantly has a bad taste in my mouth because she loved it. I mean, she loves it. That's bad news. Well, I mean, huh. Yeah, I cannot deny it's sort of the spot to try. Like horribly technical. Like it does not it does not look good to me, technically speaking. 30, I'm in there with you. Tag me. When this thing's at 30 in a couple weeks, tag me and I'll be in there with you. Right around here, we've given up these recent majors. We tried to bounce this, given up these recent major lows, a bunch of them. We only have a couple major lows left down here. Left down here. Technically speaking, it looks terrible. I mean, it's down 66% from highs or something like that. So technically speaking, it doesn't look very, very good. Bottom fishing, you want to take a nibble on, I would recommend shares if you were going to do something like this. Or, long-term leap, get yourself a year and be ready for some pain down to 30, potentially add at 30. And then abort mission under 26, but I mean, God, that's $13. You don't really want to risk 30% to me. I mean, this is like, if I was really going to trade this, I'm trying at 38 and I'm admitting I'm wrong at probably about 37 and moving on. Nice. I know this one. I know people talk about it. It was again, it was one of those just hype runners like, years ago. We can see whatever that did off that IPO. 92 to 130 in a couple of weeks and then death. But this one I hear, just randoms talk about every once in a while. I can't speak about the company, can't speak about the fundamentals, but it wouldn't for me necessarily be something I'd be quite rushing into just yet. God, it did have a big old blowout. they were expecting an 8 cent per share loss and it put up a 17% share gain. I mean, they beat that thing by hundreds of percent. That's pretty good. All honesty. I mean, wow, they beat just every time. Dude, what's going on with this? How does it beat every single time and just get throttled every single time? That's crazy. I don't know what's going on there. Dude, Marvel, if you aren't in there, be in there. This is like, I'm not even gonna lie, this is one of my only share positions. You gotta be in there. Yeah, you gotta be in there. You have to be in there. Yeah, but okay, so I did, we're gonna go for just a couple more minutes. I did want to circle back. I forgot I had one more thing I talked about because we discussed fundamentals. And do they matter anymore? I'm gonna say no-ish. And I'm saying this because you brought it up. PLTR. PLTR has no business trading where it is. I mean, it is, I would argue it's the most overvalued company in the S&P. You got a company, you got a, you got a company putting up, I don't know, $500 million in revenue or something like that. I think, something $500 million in revenue a year. Maybe it's $1 billion in revenue a year, trading at $443 billion. It is, I'd argue that it's the most overvalued company. Their guidance isn't even that like phenomenal. It's just unbeatable. The other one, Tesla, they're hemorrhaging money. They lose tons of money. Sales are going down. There is nothing fundamentally good about Tesla. And it's trading at $340 a share. Probably like, I don't even know. Is it at a trillion market cap? I don't even know Tesla's market cap, nor do I care. Fair value on Tesla, $50, $70. I mean, it's price to book ratio, horrible. PE ratio, horrible. Fundamentally, it's terrible. You shouldn't be in Tesla. Doesn't matter. Tesla rallies, there's also the other side of it. I'm going to use Crash again. This is an interesting one. ASTS. Is it overvalued? Maybe. It's not. Their focus is not on revenue yet. They're still, they're focusing on growth. They're focusing on advancement, and they're focusing on telling us what they believe they are capable of. So we saw they had earnings yesterday. Massive miss on EPS. Very large miss on revenue. Yes, investing like every penny they got in themselves. That's it. And I like this. This is the kind of thing you can buy. You can also see investors are saying they love it too. When you're rallying off, 45 to 55 in a day, investors are ignoring the negative side of the fundamentals, looking at the potential growth. So is it worth being in there? In my opinion, yes. I ain't buying at 50, but the next dip is worth a buy. My next favorite one, we'll go to it again. AT&T. Absolutely, got absolutely roasted back here. For a couple of years or whatever, absolutely roasted back here. Well, they were taking on massive debt to expand their fiber network, to expand their internet, to expand every single thing. They were taking on huge debt and investing in themselves. And do you want to know what happened at this earnings call? They said, okay, our focus is no longer expanding the network. Our focus is now on reducing our debt and increasing our subscribers. So when you trade AT&T, there's two things that matter in their, AT&T for earnings or anything like that. There's two things that matter in their earnings. Is debt going down and our subscriber numbers going up? And in every single earnings for the last 2 years, debt's going down, subscribers are going up. Are they making money hand over fist like they used to? Nope, but they're heading in the right direction. So you get involved in that type of thing. It's those weird, that's why fundamentals can work really, really great. Something like AT&T, this thing is running for a reason. Something like ASTS, the fundamentals are bad, not bad, but they're in the rocky portion before they get good. Still worth an investment. Or Tesla, terrible fundamentals, terrible outlook, sales going down, costs of things going up, and they're rallying when they should be dumping, so it's just fundamentals need to be a small portion of your plan. But the chart is the truth. The chart's never going to lie to you. Fundamentals will lie to you. We've seen it all, you know? Look at SMCI. They'll lie out of their teeth in those kinds of things. The chart is the truth. That's why I say when you're a long-term investor, you need not only a fundamental breakdown, you need a technical breakdown, because it can be the worst thing on the planet. And if people want to buy, then you stay with it. You know, it can be terrible. Like, I mean, look at like some of these war names. I'm not saying it's like bad, you know, but Lockheed Martin, like, wonderful long-term investment. And you know, I just like, I don't want to, you know, I don't want to be like, I don't know how to um I don't know how to be like not horrible when I say this. But you can identify where everything changed for Lockheed Martin. And again, I don't want to be terrible. So like, and again, I don't want to be terrible. We're going to put it out right here and we're going to say, okay, this is where Lockheed Martin, everything changed for them. That is where, oh, look, we can't even see it now. So here's our dot right here. This is where everything changed for Lockheed Martin. Why did everything change for Lockheed Martin right here? This is 9/11. You know, their entire fundamentals change. Every single thing changed for Lockheed Martin after 9/11. You know, this is where it all started to happen. And look at the rally just on the back of it. You know, this was, you know, they didn't have some like massive change in their fundamentals. We had this worldwide fundamental that we're likely going to be at war for a while. And investors bought that, you know, to the tune of a 300-400% run in just a few years, you know. So yeah, you always got to look at the big picture of everything that's going on. Lockheed Martin, nobody was buying it in the early 2000s. There was no reason to be buying here. We needed the change, you know. So like, you always have to look big picture. You always have to look at what the chart tells you. And you always have to look at what the world tells you. You know, my dad, he's been involved with the stock market for a very long time. His very best investments are on what do people want and need right now, you know. I mean, that's a great way to do it. Great way to be a long-term investor, you know, is that for sure. And so you can always go back and look at the charts. The charts will always tell you the truth, and the charts will always tell you what to do. Fundamentals can lie, chart can never lie to you. But with that, I got to call it right now. I got a couple things to go take care of. But thank you all. This was an awesome lecture. I ended up with like almost 30 people in here. That shocked me. So thank you, everybody. Yep, thanks, Nick, Crash, everybody, Josh, great questions tonight. Really appreciate all of you. And we will catch you all tomorrow. Have a good night. Talk to you later. I love you, Georgia. Go. We'll talk to you guys soon. Thanks.